with chaos at the New York Stock Exchange.
Get back in there at once and sell! Sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's going crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Chief Investment Officer at BIG Investment Services. That's BIG, Booth Investment Group. We're a full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, the first day of spring, March 20th, 2026. Happy spring to everybody. Some big shout outs to Richard, Carl, Jeff, Lynn, Molly, Jake, all the folks tuning in week in and week out. Stand up on your money. We appreciate it. So what's going on in the markets this week? Well, no surprises. We talked last week that we thought things might be headed lower. We were watching that 200-day moving average. All that kind of came to fruition this week. So markets are down. Dow Jones down 2.1% this week. S&P 500 down 1.9%. The NASDAQ Composite down 2%. And the Russell Small Cap Index down 1.6% on the week. So all major indices going lower this week. The volatility index, it was down on the week, down 1.5%, finishing at a 26.7, but it's kind of been up and down this week. It's up 11% just today. I think it's still too low. I don't think we've seen that capitulatory moment where people just give up, or they just throw in the towel, sell it all, get me out, I'm done, I'm too scared, and the market just crumbles, right? When the market's down 3-4% in a single day, maybe we get the benefit of having some circuit breakers kick and the market actually be frozen, the trading be frozen. That would be a wonderful thing to see. Volatility index get up in the upper 30s, maybe 40s. That would be great. Real pain, fear, blood in the streets. That's what gets me excited. Just haven't seen that yet. It's actually been rather orderly when you really consider things and look at the big picture. It's been a pretty orderly decline. No real big spikes in fear, except for a couple of weeks ago when all this first got started. So I like to see some more pain. I like to see some more fear in the market to get a little bit more constructive, get a little bit more excited. I think the volatility index can go higher. We'll be watching that and see if that unfolds. But right now, it's kind of like in a place where I don't really think it's saying much of anything. The TLT, that's long-term bonds as measured by the TLT, also down this week, down 0.8%. Look, bonds are not helping investors. This is so reminiscent of 2022. You've got the S&P 500 down 4.9% on the year. And you got long-term bonds as measured by the TLT down 1.5% on the year. Nothing's working when it comes to traditional asset allocation of stocks and bonds. Now, in our case, the largest position we have in nearly all of our models is a managed futures strategy. This is a strategy that tracks the trends in commodities. For the week, it was down 0.2%. So 0.2%, still up 11.5% on the year. It's really been doing a great job for us. 2022 was such a frustrating year. I said, I have to make sure this never happens again. I've got to find a better diversifier, something that's going to work in a market like we're in right now. And the managed futures are doing the job. So happy about that. How about some other things? By the way, before I go forward, I will circle back around to why bonds aren't doing well, okay? Because it is disappointing. You would hope to see bonds being a lot stronger in such a weak market, but there's a reason for it, and I'll tell you about it in a moment. What about the sectors? Well, the only things that really did well this week were energy, once again, up 2.8 on the week. It's up 32.6% on the year. And then a surprise were bank stocks, okay? Bank stocks, which are the worst performing sector year to date, down 10.5% almost. They actually were up 0.4% this week. So is that saying something? Are we seeing that maybe the banking sector fears are kind of calming down? Maybe that washout is over with? I don't know, but they did perform pretty well this week compared to everything else. And then gold and silver. Wow. Gold down 10% on the week. and silver down 15.4%. Silver now negative on the year. And I'm not the type of person to say I told you so, but, well, we'll just leave it there. Anyway, so what's moving markets? Well, as you might expect, it's Iran, it's interest rates, it's inflation fears, it's all this stuff working together. So let's address Iran first. Look, I mentioned last week that the longer this thing drags on, the more pain we're likely to experience. And so with the Strait of Hormuz, not only do you have the energy issues, the oil, but you also have things like fertilizer. A lot of fertilizer comes through the Strait of Hormuz. That's going to drive up costs for farmers. That's going to carry right into food supply prices and things along those lines. You've got helium. It's a major thoroughfare for helium. And helium is needed to make all these computer chips that we so desperately need these days. And there's no alternative. There really isn't. So you've got more than just oil affecting prices here. You've got a few different things going through the Strait of Hormuz. But then on top of that, to Iran's credit, they are fighting back. They're not being very effective fighting Israel. So instead, they're going after the global pocketbook. They attacked a major natural gas facility in Qatar this week. And then they turned around and blew up a major oil refinery in Kuwait. Now, here's the problem. The Strait of Hormuz is one thing. You shut down the Strait of Hormuz, you restrict the flow of oil, you drive up global oil prices, and then once things settle, Strait opens back up, oil flows freely, prices come back down, yada, yada. But when you blow up refineries, right? You blow up natural gas facilities and destroy them. This is production that's being taken offline, not just for a couple of weeks, or even a couple of months. I mean, it could take like months to a year or more to rebuild these facilities. This could have a major impact on global energy supplies for a longer period of time. The market's seeing that, and we're seeing that in the rise of oil. Now, folks are saying, oh, David, the U.S. is energy independent. We pump enough oil to take care of our own. We don't need to worry about this stuff. No, that's just not true. The market's a global market. Yes, we produce enough to cover our own needs, but a lot of this stuff's being exported. It's a global market in and of itself. So when there's supply shocks around the world, demand is still there, supply is not, prices go up on oil, and it's going to drive up prices here too, because it's a global market. We're not isolated in that regard. So there's a lot to be said about all of that. In addition to that, you had Fed Chair Jay Powell and company get together this week and weigh in on inflation and interest rates. They did not make any moves on interest rates, but what's more concerning is they took a hawkish stance. They are concerned about oil's impact on inflation. And I just want to grab these people and shake them, along with all the other economists. I just want to shake them and shake some sense into them, say, what are you thinking right now? They're worried about inflation, and they're so worried about it that the market is now pricing in a potential rate hike. Look, we were pricing in rate cuts for the year, and now the market's pricing in just barely a potential rate hike towards the end of the year. I mentioned coming into this year that the market was off sides for that. It was not ready for inflation to be sticky and rates to potentially go higher instead of lower. And we're seeing some of that play out. That's why bonds are performing poorly. That's why bonds are taking a hit. But why do I want to shake some sense into these people? Because you have to look at the situation. It's one thing when inflation's running out of control because you printed $6 trillion and dumped it into people's bank accounts. Hello, COVID policy. That's one thing. It's another when Iran's blowing up oil facilities and oil supply is taking a big hit, because when oil supply takes a big hit, it is hurting consumers. The consumers aren't driving the price up because they're being greedy with their demand. Prices are being driven up because supply is being taken offline and consumers are going to be hurting. And you're going to raise rates? You're going to raise rates in the face of that? Look, I'm sorry. I understand the basics of monetary economics and supply and demand, et cetera. I just don't think this is a wise move. I don't think it's even wise for the market to be contemplating this, and the market's contemplating it pretty heavily at the moment. I think not only should you not raise rates, you should be thinking about rate cuts, because the consumer is in pain. The pain is going to get deeper if this continues. So we'll see how all that shakes out. But it was disappointing. The market's reacting to that, obviously. That's why bonds are doing poorly. That's also impacting some equities, et cetera, et cetera. So all that stuff is going on. So all of that said, where do we sit right now? What's the expectation moving forward? Couple of things. Like I mentioned to you last week, we had some important technical levels. The 200-day moving average was in front of us. I thought we would go down to it and test that. Not only did we test it, we broke through it. So we went through the 200-day moving average. And then the big line in the sand that I've been watching is about 65.40 on the S&P 500. Those were the lows that we had back in the fall of 2025. By the way, we're back at September levels. Hello, September. I mean, it's 6-7 months. Here we are. Market's gone nowhere. But we had some lows back in the fall, 65.40, and I thought the market needed to hold those levels, and it did not. Broke through them today. Here on Friday, we broke through to the low side on that. Talking to some of our technical strategists, we work with some of the best folks, I think, on the planet, and Fair Lead Strategies, for example, said, look, if we close below 66.19 this week, it probably opens the door to go down around 6,100 on the S&P. That's just under 10% lower than where we are right now. I think that's a high probability. Now, all that said, we're also at a place where there's a couple of measurements on the technicals that suggest the market's a bit oversold. We could see a little bit of a bounce, especially if there's any sort of calming news out of the Middle East over the weekend. Now, there's a couple of conflicting reports right now. On one hand, I heard today that the Trump administration is preparing for boots on the ground in Iran. I think it's going to be horrible if that happens. On the other hand, after the market closed today, President Trump put a post on social media saying that things are winding down. We're winding down, and we're not going to be the ones to babysit the Trader moves. It's up to everybody else and these different things. So conflicting reports. We'll see how it all plays out. But the market could see a little bit of a bounce. But these things normally play out in phases. It's normally a process. It's not a one and done when you've experienced the level of pain that's been experienced so far. So I do think that it could be a bounce, but I wouldn't really trust it. I don't think I would really trust that bounce. I think the market could definitely go lower. And that's kind of what we're looking at the moment. That probably will go lower. We shall see. All of that said, we're not doing any buying right now. The only thing we're doing is new money from clients, new money for new clients coming into our practice. We're getting your money put to work because the market's down and there's no crystal ball. So we're getting you invested into the models. But I haven't done any extra buying in the models yet because we broke through that 200-day moving average. We did a little bit of buying at the 5% down a couple of weeks ago. The VIX was over 30. There's a little bit of fear there. The market was down 5%. We did a little nibbling, just a little bit. But we haven't done anything since then. We're just kind of holding tight here because I just don't like what I'm seeing, and I think the market will go lower. And as I've pointed out many times in the past, there's a month-end indicator that I really focus in on. Right now, we are below it. Now, it's a monthly indicator, and the key is where does the month close? If it closes where it closes right now, or somewhere around this level, we're going to get more defensive because that usually spells bigger trouble. If we regain that level by the end of the month, then we will look to be maybe more constructive. So we're just going to hang out here for the next 7 trading days. We'll watch things pretty closely. If we get some sort of real big panic, real big flush to the downside, yeah, you know me. I can't sit there and let that slide. I got to jump in and buy something. But aside from that, we're just going to hold tight here and let things play out. Now, before I wrap up, there's a lot of you that have a strategy to take advantage of down markets, mainly Roth conversion strategies. You know how we work here at BIG. We put the folks that are doing Roth conversion strategies. By the way, big shout out to Rudy. Big shout out, Rudy. You reached out and asked about that this week. Said, hey, markets are down. Are we doing anything with our Roth conversion strategy? Not yet. We haven't done it yet. Market's been painful, but our models haven't. Here's the problem that we're running into right now. The investments that folks have, the accounts that they have, they're up on the year. We're not negative on the year. The market's down 5%, but we are not. So we just haven't seen the pain in the portfolios to really jump in and do these conversions. However, we're going to be looking hard over the weekend at maybe carving things up a little bit and shifting some of the stocks that are down and moving them out from your traditional IRAs to your Roth IRAs for those that are in those conversion strategies. So we'll be examining that this weekend and probably implementing that next week. I'm going to leave the bonds and leave the managed futures where they are and just try to move the things that are down and take advantage of the market being where it is at the moment. So that's what I've got for you this week. I know it's another long one, a lot going on. A lot of folks are curious. They're worried about their money. Listen, the reason why we're not making any big moves right now, because we made them. Remember that, folks. We made the big moves before we even started 2026 because we were worried about the market from the very get-go. So we're in a really good place, and we're going to just kind of see how things unfold, see where this monthly indicator finishes, because that's important to me, and then we'll react accordingly unless we get that big, scary move down and fear and all that kind of stuff. We might take advantage of that. But aside from that, We're going to hold tight for right now and see how things play out towards the end of the month. So between now and next week, as you're thinking about your future, your long-term goals, all the things you want to do with you and your money, maybe just book that special trip for a special birthday. Maybe it is retire a little earlier, just retire on time, which, by the way, nothing's been thrown off track here. Hey, look, whatever your goals are, don't just think about it. Think big. Think B-I-G, and I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.